Hello, this is Bruce Wan, Head of Research for MaxCap Group. In this video, I want to talk about the forward outlook for interest rates and more importantly, what that might mean for real estate markets in 2025, particularly from a private credit perspective. Since 2022, we have seen in Australia and many parts of the world one of the most aggressive runs of interest rate hikes in modern history. The move from zero to a 13-year high has brought a clear slowdown in the economy and market changes in the investment landscape. In 2024, there was growing market acceptance that we have seen a peak in the interest rate cycle, although inflation remained too high to warrant lower rates. Nevertheless, many other countries with higher rates and low inflation have started to make meaningful cuts to their cash rates. In 2025, markets are more confidently pricing in rate cuts in Australia. However, the expected reduction, somewhere between 1 and 2 rate cuts over the next year, are relatively minor, especially compared to other major developed markets. As the economy moves to lower rates in 2025, we do expect to see clear shifts in momentum, particularly to the most rate-sensitive sectors like consumer spending and housing construction. For the building sector, long constrained by high material costs and high borrowing costs, we expect to see a stronger outlook in 2025. The combination of slower cost inflation and lower funding costs should drive a decisive cyclical turning point. Meanwhile, for home buyers, higher mortgage rates have been the most prominent factor behind the debilitating squeeze on housing affordability. With mortgage rates set to fall in 2025, this should provide much needed relief for financially strained household budgets. Altogether, we expect that a small step down in rates should provide a big step up in borrower sentiment. We are looking at a much better alignment of tailwinds for the housing market from mid-2025, unleashed by lower rates, stronger sentiment, and slightly better affordability. Meanwhile, for private credit investors, the world of elevated interest rate has been a big boon for investment returns, from the explicit rate hedge for issuers of floating rate loans, and partly by the relative outperformance of private credit compared to many other equity strategies. With the expected peak and decline in interest rates, where do private credit returns go from here? Looking at this chart, we can separately identify historical investment returns under different growth and rate regimes to see how different asset classes performed under each setting. For starters, the modest rate cuts currently priced in do not really constitute a clear regime change. We expect better economic growth ahead, but we are still dealing with higher for longer interest rates. Historically, private commercial real estate debt has delivered very consistent returns across different regimes through strong and weak growth phases and through high and low interest rate environments. The mechanics of this resiliency are pretty simple, particularly as private credit managers pivoted from fixed to floating rate loans with rising interest rates from 2022. At the same time, lenders are already installing interest rate floors in case policy rates fall by more than expected. All of this goes a long way to sustaining returns across the cycle in different economic growth and interest rate environments. Now, if you want to get access to these all-weather opportunities in commercial real estate debt, feel free to reach out and talk to our capital team. This has been Bruce Wan from MaxCap Group.